interesting topic, which is about due diligence. And to the authors, we have Mr. Shiva Shanker, who is the Vice President Investments at Ankur.
So just wanted to actually kick off with you guys. I know this was, as we were talking through internally about what to focus on and what was the way to add value. One of the areas we talked about is saying a transition from having gone through and what is the storytelling, what is the pitch that you guys should position. I thought it would be interesting to say, as you are going through this process and after the initial discussion, after the initial pitch, what is the way the investor is actually looking through? What are some of the general thought processes that are there? So the first slide is going to be a bit more of a general overview on the business due diligence, which will probably be a little bit of a transition from what we just covered in your last session, and then go deeper into what do the investors look for when they have crossed this stage and are actually appointing an external agency. So those three broad pillars are the business due diligence, which we're just kicking off into now, and then what ends up being the external provider's involvement, which is where a financial or legal due diligence normally comes in. So when you're engaging with an investor, normally the core of what they're doing is the analysis of your business, getting comfortable with the founders, the business model, getting comfortable with how the evolution will evolve with their own thesis. That's all aspects of the business due diligence that they do internally themselves. So that'll just cover the business due diligence aspects. When it comes to the financial and the legal due diligence, that's verification of effectively the discussions that you've had in the initial conversations with the investors that are focusing on different elements, which we'll just talk through. But broadly, when you look at the business DD, if we're just kind of diving into that topic itself, there's these four aspects that how a fund or any investor will look at it. One is an understanding of your business itself. And there could be variations in your business model, just including in the edtech space. There could be companies that are looking to build partnerships with large associations, get accreditations with large university organizations. There can be some companies which are trying to develop a sticky free offering. There are going to be companies that are trying to look at it from saying, if we acquire users, here's kind of sets of products we can bring in and go through a larger sales cycle of trying to upsell and have an ongoing relationship from a financial perspective with customers. So your business model will generally be bucketed into saying, what is the theme that you're fitting at into it? And of course, the segments you're looking at. So what the investors are analyzing is, how does this fit against their own view of what the business model is? This is not to say there's always a clear-cut bucket for every company. You have inherently models that come through in edtech. We've seen themes that have come through in the last year as well. For companies doing something very radically different, which includes doing analysis of how notations are taken, how grading is actually taking place for graphical analysis, and what the implications of that can be as a tool, because your typical OCRs cannot cover that. So you have new models that do evolve. But generally, the investor will be looking at it against the frame of how does this compare to others that I've seen, and what are the unique points that you guys are able to stand out. And that will evolve on how you're explaining the business, but also revolve around the founders. Because if you think of just from a investor's perspective, if I'm looking at a company that is looking at a higher ed upskilling course that is specializing in, let's say, a technical course of saying full stack developers or so on, I would have probably seen 5 or 6 of those in the past that I've had some decent discussion with as well. There'll be aspects of the business model that will be fairly similar to the next company I speak to in this theme. But what is standing out is the entrepreneur's ability to execute and our own judgment of that, rather than something factual in that sense. So a lot of time then gets spent on analyzing, is this the right skill set as we as investors determine what we want to look for as a team that we think has a higher likelihood of success in this field. So what is the right composition of not specifically the CEO skill set, but the team that he has as a core team or what he's looking to build together? Is this the right type of composition for us to feel like this has increasing our probability of success more than other models we may have seen in the space? So that's the broad thesis that we're looking at when we're diving in. I'm going to go through the topics at a slightly higher level at this point, because I want to talk for 10-15 minutes. I want to leave it more time open for us to go through Q&A. But this is the theme that investors focus a lot of time on, and why even when you're seeing a similar model, you're trying to spend time with the founders to actually get a much more nuanced understanding of this. The third, which is something, again, from a thematic element, founders may have a slightly different way of percepting and communicating this than investors. But typically as an investor, I would, if someone's coming in with, let's stay with that same example, someone's coming in with an upskilling course of saying, I want to upskill people to be able to provide them full stack development opportunities. That's great, but there's a difference in how you can actually communicate that, saying here is how I'm looking at model 1 of what I'm evolving into. Here's why I'm looking at adding in other modules that align well with my business, align well with the customers I'm already adding. And this is why, I'm not doing it now. I'm maybe doing it at the end of a 1 or 2 year period. But here's how my brand proposition is actually expanding. And the reason you're trying to do that is also saying, as an investor, there are limitations of what we can do as number of investments in a sector. We'd love to invest in the largest company or who will be the largest company in that space. So if you can also clearly illustrate, this is how your vision is much larger than the initial product offering, that's a critical element to make sure the investor sees, here's how you're actually showing a much larger market than what the initial product may involve. And that's why some companies actually find it easier to stand out from the other. And I know in the earlier discussion of the pitch, you would have talked through this in a bit more detail. But this is a critical element for the investor because it allows for a much more upside value capture, and ties in with the last point also of what the fund requirements are. So what you'll typically find is an investment fund which is managing a multi-million-dollar fund, is expecting to deploy capital over multiple rounds. You may say, I have a great use of funds for example, come to us of saying we may have a great use of funds for the first 1 million you invest, and we can give you a 10x return on that investment. Even if that's the case, for us, that may not be an upside we're entirely comfortable with, because we want to see that the company is actually growing to a much larger potential. So part of that journey may involve the company needs to get into more product lines, adds in more features, looks to raise follow-on rounds as well, that allow us to also not just invest the $1 million, but invest much more than that in follow-on rounds, and then take the company to an upside scenario, which on an aggregate basis means the company may have taken $5 million from us, gotten to a return profile that is still 10x on that larger base that has gone over subsequent rounds. So that's the way a lot of investors will view it, because especially with institutional funds, there are limitations in how they can actually look through it. Family offices and individual investors are probably less worried about the follow-on potential. They want to just see there is strength coming through. But it's important for you to know who is looking at the business and how they're going to come about it. I think from an institutional fund perspective, all the other institutional funds in the market as well will have this perception of saying, how much bigger can this be? Will it actually allow me to deploy enough investment for it to be worth the management bandwidth that we allocate ourselves to supporting the business, bringing the connections in, adding value over the investment horizon. As an angel investor who's doing a small single check and is not probably looking to be as engaged on a follow-on level, they're probably less involved and less interested in this element. But it's important to think of what that means for the fund's dynamic and the investor's dynamic. And that's why that last point actually varies a lot on who is doing the business diligence, because this comes in from their own baggage as well and what their own limitations and requirements are. So that was it on the business DD overall. I think some of the aspects of data that you guys can expect to prepare, and this will vary slightly by business models, but you can expect for, again, I'll send this out as a note afterwards. You can expect for most of these aspects to be put across, right? From cohort analysis of how sticky are the users who were added 3 months ago? Are they still staying around using the application? Is there something there? To your projections and being able to show how you guys are visualizing the additional business lines, the incremental growth really playing out over a longer horizon. So these are all different cases of this, and we can go through this as you guys have specific questions at the end, but just thought I'd flag some specific ideas there. Then I want to dive into financial and legal DD. So once you've got an investor who has probably had 2-3 follow-on calls with you, gotten to a certain level of comfort, or spent enough time with you guys to feel comfortable with the business model, typically what will happen is they will issue you a term sheet and say it is subject to financial and legal due diligence. This is a part of the process that normally gets overlooked by a lot of other companies, saying once I've got a term sheet, I know I'm good, I can ramp up very quickly. While that is the case, the financial and business diligence can take 2 weeks to close off, but I've seen cases where it's taken 4 months to close off. And knowing that you can optimize this as much as possible can buy your business time at a critical juncture where you are now undercapitalized for 3 or 4 months waiting for money to come in if these things are not done right. So just having really simple housekeeping items that we can do in advance to actually prepare for this can actually unlock a lot of value for the company overall. And especially as you look at what it means from a competitive market that we are in, where there's a number of other startups with similar models, being able to establish that and get that traction built quickly will be really important. So here are just some thematic elements that normally encompass, and this kind of cuts across the financial and legal DD. I'll put these into topics. But there's the financial elements of saying, what is the cash statements? Have you guys actually been comparing revenue in a way that is consistent with industry standards? Are the metrics that you called out and sent in early Excel sheets really verifiable when someone does a deeper analysis? those are some of the things that come on the financial side, which most of us, I think, mentally are used to expecting. The things that we don't expect are especially on the legal side, and I want to dive more time into that. So these are just some thematic elements that will come through, and what I'll do is, as a follow-up, because I know we said we'd focus this on toolkits that you guys can really use afterwards as well. There's an Excel sheet that I've sent out to the team at Uincept as well that they'll share with any of the attendees that are interested, of saying this is what a business due diligence or a financial and legal due diligence actually encompasses. So as you get an investor interested, what are the types of things you should have ready on the back end so that that does not become a long, cumbersome process. So that's a file that they can share with you guys afterwards. But the pitfalls that you actually get stuck with are especially around the legal side. So have you guys had board meetings? Was there compliance that actually happened around that? Most companies at an early stage probably don't have large, complicated board meetings, but there is compliance issues around your board meetings, because if you have not got internal registers that have your minutes saved in a certain way, which includes for just some arbitrary reasons really from a regulatory perspective as well, that it is saved in a specific format and saved in a specific methodology. If it is not there, the potential for you guys to actually get a penalty may be low from an actual base, but if it is there, the penalty includes jail time for the founders. So for us as an investor, that's something that we don't want to actually leave open as an open risk. It's an easy thing for the companies to focus for a few weeks if you actually prioritize this to get lined up and clear off. And it just helps just mitigate some low probability risks that can have very strong downside implications. So those are the types of things that typically the legal due diligence will find, that board documents are not prepared, minutes, notices, etc. need to be updated, clarified, set in the right type of format. Were there shared transfers that have happened because someone was initially envisioned to be a co-founder, left, but there was some transfers that were done from a capital-based perspective but haven't been noted in the registers. Those probably will be business issues that can, if not resolved in a timely fashion, can have big penalties as well. So you typically will need to apply to the MCA saying, here's a request of something that will need to be rectified. And they all get done, but it's a time-consuming process. And normally, if you have a good enough relationship with the investor and can show them clarity that, listen, this was an oversight, we don't want this to stall the fundraise, and you're able to show them the rest of the structural and compliance hygiene are taken care of, these things can normally happen after the funding is happening as well. The initial application happens for you guys, but these are things that we can easily close off if there's the right motivation. So these are just some areas for you guys to think of that how can we actually get this as you are engaging with investors. Also have your company secretary rather than just your accountant engaging with you of saying, listen, this is a list of things I need to have prepared and need to be ready for someone to review. Are all of these things ready? If not, start preparing it, because at some point in the next month, an investor will come in, we will need to prioritize these, and it's not worth us figuring out whether it's needed, why it's needed. These are things that are needed as standard process. So let's move to accelerate the company's growth. So it's just an important investment for you guys to make from a legal hygiene perspective. So that's the aspect that I'd actually called out on this. I want to dive into the topics that you guys are interested in this. If you want to go through the Excel sheet and the specific aspects that you guys want to talk off of saying, what does it mean for some of those other topics I called out? Happy to do that, but I want to leave the rest of the mic open now for you guys to come in with questions, and then we can take it from there. No, normally you can create the same one for each investor. So the requests that are sent in are pretty standard actually across investors. They may have some specific files they ask for that, especially if they're operationally sensitive, you may decide that I only want to share this with one investor. But typically, especially when it comes to the external diligence, it'll be common for most investors. And even if you have a consortium, typically actually investors are pretty comfortable if they know the other investors and people in the ecosystem to just say, here is what I need. As long as I know and I trust the other investor, I can just get the report shared with me rather than look at all the granular data and be able to move on forward from there. So I'd say, try to get the investors to coordinate as much as possible. So it's less time on the company that you are individually trying to send the reports over as well.
So my name is Abhinav Chowdhury.
Yeah.
I'd like to ask a question that, with respect to startups,
Mm-hmm.
when they're disclosing the intelligence, the financial,
Mm-hmm.
because these formats contain everything that is needed.
Mm-hmm.
What are the parameters that the startups founders need to keep in mind
Mm-hmm.
when they're disclosing of it?
Mm-hmm.
Because you want to allow an investment,
Mm-hmm.
might or might not have invested in the same kind of business,
Mm-hmm.
which can be public information or can be private.
Yeah.
So how does founder kind of safeguard himself with that?
Yeah, so I'll give some examples and it'll be good for you to counter on saying these are the files that actually get more complicated from a startup's perspective as well. So we've had this conversation with people, especially when it comes as early sometimes as pitch decks. And that is honestly a communication of your idea. And for us, it's less about, listen, do we have a pitch deck for this company? But do we have some notes that help us focus on this is what the founder is thinking of. And I think at that concept stage, having something that you can share, I think you need to know that this is going to openly go around. This is the concept that will, of what you are actually trying to build towards. When it comes to specific data that we ask for, so I'm going to break this into two buckets. What we ask for is business diligence, that where while we're understanding the company, and what is diligence done by an external provider, where I think the second set is honestly a little bit easier because they do need to go through the roots. They need to actually literally look at including our tally accounts to go through that on, listen, there is a reconciliation happening. That is one of the large reputed accounting firms that will do it, depending on the size of the investor, may not be the big four or something. Even we don't use the big four because it's not financially feasible for the stage even we invest at. But it's an accounting firm who's got a reputation in the market and is also signing off with you guys as a non-compete as part of what their terms are. So you guys will, and a non-disclosure, as a part of the standard terms with you guys. So that is covered for when it comes to very granular data. When you're sharing it with an investor saying, here are my customers and here's kind of the customer cohort retention. Your cohort retention is a summary of how the cohorts have behaved. So everyone who was added in April of this year, how many of them were sticky in April, May, June, etc. So that's giving a summarized version of the metric. So while it is showing, is your product really sticky? That's something the investor needs to understand. But there's not much that you can do to really secure that. When it comes to company-specific metric or customer-specific metrics, what I'd actually push back on the investor on saying is, listen, we're happy to introduce you to our customers, but this as a separate step. But we've taken out the customer names, contacts, etc. from this file. So what we've left you with is, here is the trajectory of series of customers in here. We've taken out all the confidential information, which is customer related. So I'd say that's the easy way to resolve it, of saying, you know what is the confidential part of that file, and say, listen, we're willing to remove it. If you want to, you will, as Diligence, want to connect with some of our customers. So of this trajectory of customers, tell us which are the ones you're interested in. We've put a randomized customer number. Give me that number, I'll send you the phone number of those customers, and you can do a reference check of how their trajectory has been, what they think of the product, etc. So I'd say that's probably a good way to do it. If there's some specific instances that you feel or some data points that you feel have been uncomfortable, happy to talk through those specific cases as well.
So just to follow up, we have a lot of startups here.
Mm-hmm.
I'm sure everybody has this kind of inquisitiveness.
Mm-hmm.
That what basic, the most essential files or information has to be communicated to business. When going for fundraising or investments, when you're just seeking people to move.
Yeah, so I'd say these are all data points that you guys should have mentally ready. So whether it's your monthly budget, your unit economics, your historical financials, your own cohort analysis, we're expecting honestly that there may not be a very specific dedicated file that is an auto-updated dashboard for these things, but there is some format by which you are actually as founders going back and checking, is my customer sticky? Were the cohorts that were added a few months ago, are they still there, or is my, if I'm a company that is working off monthly active users, is my MAU only coming from recent users? So there's a massive churn. Because if there's a massive churn of users, that's a problem actually that you as founders need to be actively managing. So I'd say these are data points that would help us get a better understanding of, is there a stickiness of the customer in a user base? And these are things we are assuming the companies will be using for their own internal management. I think the projections are the only one that we feel should be set up in a way that visualizes and kind of complements the projection or the pitch that you guys will be doing. The rest of things we're assuming you guys are developing in-house to manage your own business well.
I just wanted to ask, from an investor point of view, the product metrics retention or referral is important, or the revenue metrics, how much revenue the company is making, which point is important for the investor?
So both, and it kind of varies based on the business model you guys are in. So I'd say if you're in a model where a lot of the value capture for the customer happens upfront, then I'm less probably worried about retention. That being said, it's a question of how that retention and revenue ties in with what is the potential scale of the company when we're saying what it will look like 4 or 5 years down the line. If you're going to tell me I have a very high revenue upfront from a customer, but they almost immediately churn and most of them churn off. But I'm assuming that will change by year 5, and that's why, only because that changes, is my company very valuable. If that's the effective summary of how I should look at how you guys get to scale, then what I'd be actually pushing back on is saying, how do we actually look at how that will change? And are there internal signals that you guys are tracking of, it was initially that churn rate was 95%, it's now gone down to 85%. Here's what we've done to try to do that, and here's why there's a focus on those initiatives. So I think showing that there is that signal of both of those data points you mentioned, the cohort retention, the revenue, tie in with what you look like at a large scale. And if you can communicate how the combination of those drive value at a large scale, I think that's demonstrating to the investor what you are actually building out.
So when it comes to financial due diligence, so there are certain ratios that investors look for. So could you please elaborate on those and also you could mention how those vary as per the stage of the startup?
Yeah, so I'd say it's honestly less about ratios, because when you've come to financial diligence as well, normally what you'd find is the investor has probably asked for data points like this that gave them their expectation of what those metrics are. So when you've given your MIS, etc., you have given that this is what my customer acquisition is, here's what I'm actually generating as revenue per user, here's how that's changing, some version of a cohort analysis, by which they have probably told you this is what our expectation for the business model is, and the internal financials as an overall picture are. And the financial diligence is a verification of that. So as long as the internal data, honestly, that has been communicated in these files is consistent with the financial diligence, there probably isn't much that they will look for, barring the fact that were there other things that were not disclosed. Are there lots of loans that have been taken out that need to be paid out in a short-term horizon? Are there some structural issues like the shares actually being held by someone else that they don't know about? So those are the types of things that can come up in a financial diligence. But I'd say honestly be open on what those are, because they probably asked for a metric or a MIS upfront and told you if a MIS was, for example, we've had times where we've asked for the companies for existing financials, received very high-level metrics of saying, here's my revenue expenses broken up into 2 or 3 headers, and this is my profit or loss. At that point, the investor will come back saying, hey, for your business model, I'm trying to understand customer acquisition costs. So can you give me how many customers were added in each of these months? And can I compare that to the marketing header, which isn't really called out in here? And what else is there as marketing related costs? Can you talk me through whether it's salary of people who are focusing explicitly on marketing or other types of things? So you'll have that conversation with the investor. These are the metrics that I'm looking for. Wasn't really represented in the sheet. Can I get that out? So I think that will vary based on the business model. And if you guys have specific business models that you're concerned about, of saying, how does it look at for K-12 course sales if I'm selling it from a Baiju type model? I mean, I'm happy to discuss the specifics for some of those cases, but on a conceptual level, it'll be what was discussed really at the initial few calls with the investors as well, because they will ask you for what metrics they're looking for. So a few metrics to keep in mind, and I'd say this is true for investors at different stages. So we've received proposals sometimes from companies also saying, here's my projections of what my cash need is for the next 5 years. While that's great that you guys have an understanding of that, you will probably be asking the investor for investments that'll give you a runway for 12 to 18 months. The reason is all the investors across the ecosystem are looking to see, has the initial project gone according to plan? Are we able to demonstrate why this is actually working? And the demonstration in a lot of ways ends up being, are you able to communicate now this expanded version of the vision? So if we're saying the company was, just going back to one of the earlier cases I called out, of saying, I'm trying to do it as a full stack engineering training course. Great, there is lots of other things you've talked about trying to do over a 5-year horizon. But first, let's get this cohort to work. Let's see that the users are actually very keen to sign up for the course. So there's going to be metrics that the investor will also call out saying, this is what we'd want you to demonstrate over 12 to 18 months, which help us say that of the models that have succeeded in this type of space, whether in other countries, in other sectors, etc., however they're looking at it, these are the models and the metrics we want you to demonstrate for us to feel like the company is moving on the right track. And then there can be additional capital, either from that same investor, other capital that they will try to raise. But typically you will find it won't be longer than a 12-18 month horizon that they'll be funding. There are models with outliers because they need more capital up front that follow a different trajectory. But generally in the VC ecosystem, you'll find normally the expectation will be you'd be able to demonstrate the model within a 12-18 month horizon and then raise the next larger round of funding. So there's some topics like financial models that in case you guys have specific questions and want to go deeper into, happy to take those up as well and just talk through some other things to just keep in mind on that. So yeah, happy to take the questions as you guys have them.
So, good morning, sir. My name is Vivek Kumar Singh, and
Mhm.
I'm from GEMS.
Okay.
I'm an active member of IIC.
Okay.
So, my question is, what an investor look first in a startup?
Mm-hmm.
Is it a revenue model or a business model?
Mm-hmm.
On that,
Yeah.
like we do look for some things that
Mhm.
are in the startup.
Mm-hmm.
But what are the downsides that you as an investor look that should be avoided at all costs? So the top things that
Yeah, so one thing I'll just flag off, and I think this is typical for people going down the VC ecosystem. What we're trying to do is focus more on maximize upside and get a maximum probability of the upside. And we know there will be risks in these business models. So it is fine if a business model has one or two challenges. So and this is why you see a lot of early stage companies get funded where the investor may have worked with the startup founder, etc. before, because they feel there is alignment in what the business could be. They're aligned in the sector that the person may be going after. They may have questions about what the specific subsegment is, etc. There is an open risk, but you say of the kind of 3-4 general categories of risk, and I can go back to the initial slide of just the areas of how an investor would look at it. If we look at these being kind of 4 broad categories of what an investor is thinking of, they're probably comfortable saying one of these is kind of imperfect, but as long as I'm saying I would rate what I've gotten as an 8 out of 10 or higher in enough of the categories, I feel there is comfort for me to go ahead. So it's less about mitigating specific risks. It's about saying, are there ways that enough of these things I feel I am able to de-risk? Because if everything was de-risked, the company would probably be raising much larger pools of money, have already demonstrated that, product market fit is there, the revenue per user is sitting at several thousands of rupees, the cost of acquisition is non-existent. If it was that good, they could just leverage debt and be able to grow. In equity, there will be some risks there. And that's something that you need to realistically just accept. But thematically, I'd say these are the 4 areas that any investor is looking at.